Good morning, traders, and welcome to BCR's morning market analysis. First up, let's talk a bit about the US dollar. The DXY fell below 99, touching its lowest level since late October last year, after the Federal Reserve cut rates by 25 basis points. The Fed signaled that only one rate cut is expected in 2026, and its statement was slightly adjusted to highlight uncertainty over the extent and timing of future adjustments. Hinting at a possible pause in January to wait for more economic data. The Fed's updated projection showed a stronger growth outlook, with 2025 GDP now expected at 2.3%, up from 1.8%, and a slight upward revision from 2027. Inflation for 2025 was trimmed to 2.5%, which is still slightly above the target. Technically, DXY has developed a clear bottom structure after weeks of controlled selling. The longer lower shadows and mid-range candles point to a two-way liquidity battle, leaving the index without strong upside or downside momentum. Key resistance stands at 99, 99.47, which is the 20-day moving average, while support sits around the 98.63 100-day SMA and 98.03. Next up, let's have a look at WTI crude oil, which trades near 58.7, pressured midweek by progress in Russia-Ukraine peace talks, expectations of increased supply, and caution ahead of the Fed decision, which came out in the morning, 25 basis point cut. A possible peace agreement and any easing of sanctions could bring more Russian crude to the market. Iraq's major oil fields also resumed production, reinforcing supply concerns. Despite the Fed cutting rates, analysts see limited short-term impact on oil demand. Markets remain cautious, keeping price action tight. Technically, crude remains within a long-term downward sloping channel, dating back to late 2023, with an additional descending channel from June 2025, reinforcing the bearish structure. Resistance is seen around the $60 mark and the 62.6 level, while any weakness below 58 could expose the $57.1 support zone. Next up, let's have a look at gold, which broke above 42.30 on Wednesday, testing the October high, which was driven by the Fed's decision and Powell's comments. Markets interpreted his remarks as leaving the door open to additional easing, with traders now assigning a 68% probability to two or more cuts in 2026. On the technical side, gold dipped below the lower trend line of its ascending channel and fell under 42.64, which was last week's high. The current move can be viewed as a rebound after the breakdown, and price needs to close above the 9-day SMA at 42.12 to regain bullish momentum. Holding around 4200 could set up another test of 42.64, 42.71, which is the high from the previous weeks, while a break below 4200 would shift focus back towards the 41.54 and 4100 dollar level. Lastly, let's have a look at the Australian dollar, which is trading near 66.70, which is its highest level in nearly 3 months, supported by the RBA's hawkish tone. While the cash rate was kept unchanged, Governor Michelle Bullock ruled out further cuts and even indicated the possibility of a rate hike in February if inflation does not ease. The US dollar's broader softness added support, with the dollar index hovering near a 5-week low. The Australian dollar has now risen for 12 consecutive trading days, briefly touching the key 66.85 zone. Technically, the Australian dollar is in a firm uptrend, having broken multiple short-term resistance. Resistance sits around the 67-cent mark. RSI is near 70, suggesting potential volatility, but momentum remains pretty strong. Support levels to watch would include the 66-cent psychological level, the 65.53 level, and the 50 to 100-day SMA intersection near 65.37. Well, that's all for today's morning market analysis. Thank you for tuning in. As always, manage your risk and happy trading.